Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 122 on July 11th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Inovio Pharmaceuticals, Advanced Micro Devices, and Square Incorporated. And we discuss three new trades on Corbus Pharmaceuticals, the iShares Silver Trust ETF, and NIO Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the stock market finished slightly higher this week. The Dow Jones Industrial Average gained 248 points, ending the week at 26,075 points. The S&P 500 index finished 55 points higher at 3,185 points. And now it's time for the topic of the week. Each week I discuss a topic that pertains to option trading, and this week we will discuss getting started in spread trading. I've been asked by several people why I think spread trading is the best way to get started trading options. So I'll lay a few of my standard answers here. Let's start off with defined risk. Most traders, especially non-professional traders, don't understand risk. And if they truly understand risk, you wouldn't hear options and derivatives spoken of like they're evil. So starting in spread trading when it comes to options is good because it can get the new option trader to focus on valuing risk as a basis for their trade selections. Option spreads can never be worth more than the difference between the strikes. And on this show, I typically stick with either 50-cent wide spreads or $1 wide spreads. When you consider that equity options are priced per share and are based on 100 shares, that means the total risk on these spreads is $50 or $100. I know dozens of people who managed to make their first trades in options and turn them into losses of more than $1,000. When you're starting, you should expect to lose. And consider it the price of admission, the cost of learning. You've got to pay to learn anything. I often say, and I didn't make this up, but I'll tell people, everybody learns and lessons aren't free. So why not learn in a way that lets you control the price of the lessons, right? Options just allow you to control the total risk, option spreads specifically. And if you can control the total amount of risk that you're putting on, you also will be an environment where you can think through trades and not fear having a bad decision cost you several $1,000s. The second thing I like about spread trading is that the gains are also defined. So if you buy a spread, the total value of the spread still can only be the difference between the strikes. You will know right off the bat your maximum possible gain. So lots of people get into investments with a lottery ticket mindset. You ask them how much they expect to make, and you can see them start fantasizing about Ferraris and yachts from like a one-lot purchase. Like you bought 100 shares and you think you're going to get a Ferrari out of that. That's very rare. Knowing your maximum gain is a huge part of risk management. People often think controlling risk just has to do with controlling your downside, but it also has to do with understanding your upside. You can't decide if a trade is worth taking on the downside risk if you don't have a true expectation about the possible gains to be made on the upside. So that's my second reason. And then my third and final reason for this is I like traders to get started in options using spreads because it requires a lot less capital to get started. The spread trades I present on this show can be executed by someone with a $200 account or even someone with a $100,000 account balance. Either way. So this using spreads lowers the barrier to entry to start trading options. And the sooner you start trading, the sooner you'll start to learn how to be profitable in option trading. So that's it for this week, this week's topic of the week. Let's get into the trade review from last week. And it may be rather quick. We had 2 wins and 1 loss. So we're looking at a covered call to start off with. We had Inovio Pharmaceuticals, symbol I as in India, N as in November, O as in Oscar. At the time, the stock was trading for $21.45 a share. We looked at buying stock and selling the July 22 call at $2.32, hoping for a return of 13.38% in 2 weeks. Well, Inovio Pharmaceuticals grew $1.93 per share to end the week at $23.38 per share. The call that we sold is now officially in the money, having gained 21 cents this week. This leads to a net gain of $1.72 for the trade if you were to close it out on Monday morning. Now, if you decide to hold this trade for a few more days, because we have July expiration this upcoming week, if you hold the trade through expiration, this trade will earn a total of $2.87, which is how we get to that 13.38% return on investment. So no adjustments needed in this one. My goal will be to hold it for a few more days and hopefully lock in that full return on capital. Our next trade from last week was a credit spread on Advanced Micro Devices, symbol A as in Alpha, M as in Mike, D as in Delta. At the time, the stock was trading for $52.34 a share, and I looked at selling the July 52.5 53 call spread at 17 cents, which can give us a maximum possible loss of 33 cents per spread. Well, AMD stock grew $3.52 per share, closing at $55.88 per share. The out-of-the-money call spread we sold is now actually in the money, so this one is a loss. With 1 week left until expiration, the spread is priced basically at its full value of 50 cents. That means that we've lost 33 cents per spread. Now, you can obviously walk away with that loss, or you can decide to sell some downside put spreads to try to offset some of the loss. Now, if you do that, the strike must be lower than the strikes of your call spread. Otherwise, you end up in a scenario where you could end up losing on both trades, essentially doubling your loss. Now, the July 52.5 52 put spread can be sold at the moment at 6 cents per spread. You could, in theory, sell multiple spreads, meaning you could sell 5 or 6 spreads to cover the loss on the call spread. However, I highly advise that you never enter this type of strategy without fully recognizing that the risk in the strategy would be significant if prices headed back lower and moved against you. So because of this, I would actually lean towards not selling a put spread at all and simply allowing the call spread to end in a loss at the end of the week, unfortunately. But that's also what happens when you have a spread. When you put on a trade that has a 2-week lifespan, it means that when you go to review that trade, you don't really have time to fix it or make any adjustments because you're so close to expiration. That's certainly the case in this scenario. And then our final trade last week was a debit spread. We looked at Square, Square Incorporated, symbol S as in Sierra, Q as in Quebec. At the time, the stock was trading for $113.39 per share. And I looked at buying the July 112-113 call spread for 65 cents, which could give us a maximum gain of 35 cents or a 53.85% return in 2 weeks. Now, Square Incorporated stock rallied $14.66 per share, ending the week at $128.05. The in-the-money call spread repurchased is significantly more in the money now. So if you were to close this trade early, it would be near its full value of $1 per spread. Now, for sure, if we hold the trade for a few more days, hold it until expiration on Friday, this trade will most likely expire at full value, that $1, which allows us to collect the 35 cents per spread or the 53.85% return in 2 weeks. This trade is winning and there's no additional adjustments needed. And I love this. I can't help but look at the difference in returns. So let's say that you heard this trade on Monday and decided to go ahead and just buy stock. Let's round up and say you bought stock for $114, right? The stock moved $14.66 per share this week. So on $114, that's like 12%, right? So you were able to leverage your capital and make 12% in 1 week. That's amazing, right? That's a great trade no matter how you look at it. But had you just bought these debit spreads, and this is the beauty of having of some of the leverage that's available in options, had you leveraged your capital and bought debit spreads instead, you'd be looking at a nearly 54% return on your capital. I mean, you have 12% on the stock, 54% on the options. That's why people love option trading, and that's why it makes it so worthwhile to just get to learn it. So that's it for last week's trades. Of course, I've already mentioned it a couple times. This upcoming week is options expiration for July 2020. We will move this week and for the next several weeks into focusing on trades that use the August expiration month. So let's dive in now. We're going to start off as usual with the covered call. And for the past few weeks, I've been loving these pharmaceuticals. Obviously, we have a global pandemic happening right now that is caused from a virus. So it should be no surprise from anyone that there are trades available in some of these lower valued pharmaceutical companies. So looking this week at Corbus Pharmaceuticals, symbol CRBP, C as in Charlie, R as in Romeo, B as in Bravo, P as in Papa. The stock ended the week at $7.68 per share. And I'm looking at buying stock and selling the August 9 call at $200. I'm sorry, at $2. I used the real term at first. So selling the August 9 call at $2, hoping for a maximum return, get this, of 43.23% in 6 weeks. That's crazy. So you enter this trade by buying stock for $7.68 and selling the August 9 call at $2. This trade makes the most money if stock prices finish above $9 per share, and the break-even price is $5.68 in the stock. So in real terms, the stock purchase would require $768, and you would collect $200 for selling the option. That's why I flipped over. But when you have such a low price per share, right, and you're collecting such a high premium for these call options, like it's either a sucker bet or I think it's a great opportunity. It's an insight that there's more coming. There's something else happening in this stock. It could be earnings. Definitely want to do a little bit deeper dive to make sure you understand what's happening in the stock, because the risk in a covered call is not in that option that you sold. It's in the stock purchase, right? But I like the fact that you have a $2, cushion. That by selling this call for $2, you create a $2 cushion that you can handle a stock move against it. So if the stock drops by $1, right, and finishes at $6.68, you still will be ahead because of the amount of money that you collect with the option that you sold. So that's it for the cover call. Let's look at the credit spread for the week. And this week, I'm looking at the iShares Silver Trust ETF, symbol SLV, S as in Sierra, L as in Lima, V as in Victor. The stock ended the week at $17.43 per share. I'm looking at selling the August 16.5 put spread, collecting 17 cents for that spread, which leaves us with a maximum possible loss of 33 cents per spread. Then you enter this trade by selling the August 17 put at 46 cents and concurrently buying the August 16 put for 29 cents. I'm sorry, the August 16 half put for 29 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $17 per share. The break-even price on this trade is $16.83 per share, and in real terms, you would receive $17 per spread that you sell and have $33 at risk. And then our final trade on the week this week is going to be a debit spread, looking at a company called NIO Inc., symbol N as in November, I as in India, O as in Oscar. This is an ADR because the company is based in China. The stock ended the week at $14.98 per share. I'm looking at buying the August 13-14 call spread, paying 50 cents for this spread, which can give us a maximum gain of 50 cents or a 100% return on your capital in 6 weeks. You enter this trade by buying the August 13 call for $4.55 and concurrently selling the August 14 call at $4.05. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay above $14 per share. The break-even price on this trade is $13.50. So in real terms, you will pay $50 to enter this trade, and your maximum gain is $50 per spread. It's very rare that you have an option spread like this where it's 50-50 truly, so you get a chance to double your capital in 6 weeks. That's fantastic. Thank you guys so much for listening. That's it for this week's show. I hope you enjoy it. I hope you're diving in. I love when you send me emails about your current trades. Thank you for those of you who also have thanked me for some of the trades I presented here on the show. I love making this podcast, and I love it mostly because you guys reach out to me and let me know that you listen. So say hello. I do get back to my email. Otherwise, I feel like I'm just a guy in a room or in an office talking into a microphone, staring at a computer. It gets so lonely. But I think that's the story of the coronavirus these days anyway. Definitely be safe. Find ways to be physically distant, but not socially distant. Reconnect with your social groups. I have Zoom calls. A virtual hug is still better than no hug at all. So stay safe, you guys. Thank you also for those of you who have shared this podcast with other people that trade options. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.